Support and resistance. That is what we'll be discussing today. The basic definitions of these terms, terminology, if you will, is support. What does support mean? Support is basically holding something up to stop from falling lower. That is what support is. Resistance is to resist, stop something from moving further, stop something from moving higher. Do you get resistance? In markets, in market structure, there is a lot of support and resistance playing out. Now, most times when people hear new traders, when they hear support and resistance, they freak out. They think of it as one very peculiar, special occurrence that happens only in the forex market, but it happens everywhere around you. Everywhere around you, as long as economics is going on, the support and resistance of prices. The basic example would be, let's say bread. Let's use bread for an example. Yes, the price of bread. There was a time price of bread was at a specific amount. Yes, let's say $10. Price of bread was $10. Okay, then inflation happened and prices of bread increased. Now, usually, what happens is that it's not every vendor of that bread that increases the price at the same time. There will be people who have adopted the new prices, let's say $15 now, and there will be some vendors who are still selling $10, maybe the old batch or the old stock, but for some reason, they are still selling it at $10. Now, before the inflation, you can say that that $10 was resistance in the price of bread. It didn't go above it. Price will just get to it and just it couldn't break it. But after inflation, it broke that $10. And some people started selling $15. Now, if you want to buy that bread, it means that you can get it for 15, but the lowest you're going to get it is $10. Now, we'll talk about that one, how when resistance gets broken, it turns to support. But that is just an example that I want to give to you now. That this is how it plays out in day-to-day activities around us. While some people have adopted that $15 new price that they are now selling their bread, it means that there are some vendors that may still be selling $10. So the lowest you can now get bread that used to be $10 becomes $10. It's no longer the maximum price. While the current maximum price, because of inflation, has become $15. Okay. So let's let me show you a um textbook representation of support and resistance. So it doesn't look like it's magic. It's not magic. It happens everywhere. But I just gave you an example so that you understand that even in your day-to-day activities happens. So let's say price starts from here. Yeah. Price starts from here, like which is support. It gets to resistance. Now, a lot of traders they think of it as an imaginary line in the market that price cannot pass. They think of it as an imaginary line that stops candlesticks from passing. Yeah, but there's just a little misconception. Resistance is a price. It's not an imaginary line that candlestick cannot pass. It's a price that the commodity cannot exceed at that time. Whenever it gets there, that price tag has not been exceeded before. So whenever it gets there, there's a tendency that it's going to go lower. Okay. So price gets here, it bounces back. Why does it bounce back at resistance? It's not that it's a given that it should bounce back, but this is more of a collective mentality of traders. Okay, price has not exceeded this point before. And when it gets here, there's a good chance that those that bought it at discounted price, which means those that bought it as support or lower, might want to make profit by selling it at resistance because they believe that price has not exceeded this point before, is not going to exceed it now. Yeah. So that is what usually happens. That is what makes price to bounce back. It's not an automated pattern in markets. It's the collective mentality of traders. They sell at resistance and they hope to buy at a lower price, which is basically support. Yes. Price gets to support, it bounces again. Why does it bounce? Because the traders believe that this is the cheapest discounted price any trader could get. It's at a discounted area. Just like the example I gave before, a loaf of bread that is now selling for $15. When you see it fresh, not moldy ones, when you see it fresh for $10, even if you don't want to buy bread that day and you like the bread, you'll be like, let me just buy this bread because I know that somewhere it's trading for $15. This price is discounted. So you just buy at what support. Okay. Then the price gets to resistance, bounces, gets to support, bounces, just like that. This is basically the textbook representation of support and resistance. Okay. Now, with the analogy I gave earlier that I said price of bread used to be $10. Now, after inflation, it became 15, and there are still some vendors who are still selling it at $10. So $10 now becomes the lowest possible price you can get. It's no longer the highest. It used to be the highest before inflation. But now it becomes the lowest possible price you can buy the bread, loaf of bread for. And 15 is now the new price, okay? Let's say, let me undo this. Delete. Let's see, let me now give you an example. Let's say this is the price of bread, okay? Price of bread exceeds resistance, exceeds that $10. It gets up to this point, comes down, touches here, and continues going. This usually is the relationship between support and resistance, and it plays out a lot of times in markets. I'll show a live this thing, a recent chart to buttress this point, but this happens a lot in markets. Why does this play out? It's not like it's an automated pattern that when price breaks resistance, it must come down before moving. It happens a lot, but it's not automated. Again, it's the mentality and the trading habits of traders, institutions, and bankers. These are the people with the money itself, not the individuals. Those institutions and bankers. Yeah, so usually what happens is that when price breaks resistance, it comes back to test it before going forward. And this is not like an automated pattern without logic behind it. The logic behind it is very simple. Okay, let me delete this. We have already established that based on the trading psychology, trading bias of banks, institutes, even individuals, that when price gets to resistance, a previous resistance, that there is trader sentiment that is going to sell from there down. Okay. Now, what would happen most times is that these banks or institutes, they have a lot of money. They will put their sell orders at resistance because they believe, just like you and I, they believe that when price gets to that resistance, that is going to sell. Some of them don't even use stop loss. They have that amount of money, or they use very large stop loss. Okay, let's just say they use very large stop loss. So now, what happens when price gets to support? Let me delete this. Let's try it again. So price moves from support to resistance. They've already set their cells here, believing that based on previous sentiment by traders that is going to sell from here. Okay, most times you see a reaction at this point, but if the buyers are more than sellers, you know that the resistance is not going to hold. Okay, so price breaks it. When price breaks a resistance, why does it usually come back to test it? It's very simple. Whoever opened this short trade now, at this point, is already in loss. As when price is at this point and still moving forward, it's already in loss. But if price comes back to this point, then they are no longer in loss. For them to be in profit, price has to start going down this way. Okay, but because of the buyers are more than the sellers, the chances of price coming down again to this place is very, very slim, or is slimmer, not very slim. What they do, what these banks and institutes do to mitigate their losses so that they can exit the market without loss is they start pumping in more money into the market, driving the price down back to their entry point, back to where they opened sales. When they get to this point, that's where you see that bounce, because the moment they get to this point, most of them either long or they exit the market. You see the bounce and it goes up. So when price breaks resistance, often times than not, it retests that resistance because of open orders that are trying to mitigate their losses. That is the logic behind breakouts of resistance and retest. It happens the other way around. Let's say this is support. Okay, banks, because why I use banks and institutes is that they are the ones that have enough money to influence the market to a great degree. Okay, so let's say price is at resistance and it sells from resistance coming to support. Okay, now this institute, just similar to the one we just did, they've opened a buy order at this particular support price. Okay, but because they at this particular situation, there are more sellers than buyers, you see a little reaction, then price breaks support. What do they now do? They try to push this price back to support so that they can mitigate their loss, because at this point they're already in loss. Okay, it's lower than their entry, so they are already in loss. That's when you see price go back to mitigate their losses so that they can either exit the market or they can short it. So that is the logic behind it. It's not maths, it's not magic. It's not that it's without logic. Resistance and support, as it must break and retest, it must break and retest, and they don't understand the logic behind the retest. You have to understand the logic behind it, because everything is just movement of how would I say, it's economics of value. It's economics of value. If price goes to support, it means this is the price discounted, the current price that people feel is discounted for this commodity itself. If it goes lower, it means that the traders' sentiment and bias has changed. They believe that this can be valued for less. Okay, so this is you can see from the date below, this is February, so this was just last month in AUD USD 4-hour time frame. Now if you look at this place, you see that price traveled up to the resistance and sold. Okay, sold back down and then broke out of the resistance. If you notice, you see that price tapped into that resistance before printing a new high, just like I explained. these banks and institutes try to mitigate their open orders that are already in loss, because it will not be foolish of a trader to assume that when price gets to this resistance it's going to sell. Now remember what I said, that you oftentimes see some reaction when you get to a place of resistance. You see the black candle. The black candle is the reaction you get there because of pending open orders to short the market. But because of the buying pressure was higher, it broke through and you have your retest. Okay, so this is resistance to support. Now support to resistance. Okay, the textbook version that I showed is just a clean representation of market, but it's usually not the case. It's not usually that clean, but when you look out for these things you will see them, because that is actually on the base principle of which on which market operates. The place that I highlighted, you can see that price tapped into it and started going up, which makes it a support. Now, after it, you see a sweep. These aren't full candle close, so they are sweeps. He didn't respect it. He just went down and came up. They are not full candle closes, okay? Now, eventually, you have a full candle close after, which means that support has been broken. This is the full candle close, as you can see. And when that happened, what happened next? That support became resistance. It resisted the price two times. Okay, this is the first one. This is the second one. Understand that sweeps are not full candle close. Sweeps are not full candle close. It's very important for you to distinguish between those two. Now, you can see very well how these things plays out. Support turns to resistance. Not after the sweep, after the full candle close. The full candle broke it. Then you have the institutions and banks mitigating their loss before price continues to sell. Okay, so it's pretty simple like that. All you have to do is study the market, understand what is going on, and be patient enough to execute, because at every point in this interaction with the support line turning to resistance, if you're not patient enough, you might feel, okay, this is going to be a support. Like, you see the black one before the blue one. The blue one is indicating that yes, this support may hold because of the pending open buy orders or long orders that already exist. But because the selling pressure is higher, it broke through. So you need that patience to be able to understand exactly where market is heading to. So what you have to do for your own benefit and growth in trading in your spare time, just observe support and resistance levels on higher time frames because they are more accurate. On 1 hour, 1 minute time frame is rowdy. It's just rowdy. You might get confused. Observe it on 4 hours and on 1 hour. Mark out places that you believe are support zones and resistance zones. Mark out those places with your horizontal, this one, with your horizontal markers and all that. Mark them out and watch how price reacts to at those points. If it's a valid support, most times when it flips it, it retests because of you understand the logic behind it. Now the retest may take days, it might be instant, it might be hours, it might be weeks. It doesn't have to be it's more in that day, or just because you are looking at the chart it has to happen in front of you. It can take a while, but because you know the logic behind it, you know that there's a high probability of retest. Okay, so that is what you do for your own good. Just settle down, mark out these points and observe how market reacts to it. Very important. If you can mark out support and resistance, you will see the benefits in your trading. Another form of support and resistance is in trend line. What are trend lines? Trend lines are resistance or support formed when there's a trending pattern. So let's say that AU USD is buying, okay, creating higher highs and higher lows. Yes. Now this is textbook pattern. It would not be this perfect. Yes. So this is AU DUSD creating higher highs and higher lows. Now it's very important that you know how to draw your trend line. It doesn't have to touch all the points, but at least minimum of 2 points in the trend is okay. It doesn't have to touch all the points. Okay. Now this trend line here, you can see that it's an uptrend, but it's also exhibiting support to the uptrend. Okay. Now there are situations where this trend line gets broken. Let me give an example, a textbook example. So the price is trending. Again, when you're drawing your trend line, you need a full candle close below it for you to assume that it has broken. So let's say it's trending up and down and it breaks through. Yes. The mistake some people make is when it breaks through, they get into the trade and then they short. Okay. They say, the total trend line, it has broken through. You see them do something like this, short to here, because ideally the concept behind this is that when it breaks a trend line, it's going to sweep all this liquidity that you're seeing here. Okay, it's going to sweep everything that it just created, liquidity hanging here, yes. But this is a very hasty move, because in some situations what may happen is price comes back and continues trending again. You see why it's not hasty. So when you want to trade trend line, which is a form of support and resistance, what you need are confirmations. First is a full candle close, okay. The second is a retest. We already discussed the concept of retest and what usually happens that brings about retest. So you have, let's say, you're trending up, okay. Let's say you're trending up and then you break through it. A lot of people expected that the price will bounce on the trend line and go up, and their logic is rooted in solid idea. It's not, they were not gambling. It's very rooted that you expect that price will bounce on the trend line, but when price decides not to and breaks through it, you have some of these institutions trying to break even. Okay, so they push the price back and you have your retest, and then you can now say, okay, now price has fully broken the trend line. You get, you always need your retest. So it's very important that you get a retest, whether it's trend line you're trading, whether it's the classic support and resistance. Trend line is also a form of support and resistance, because it's one way it creates support and on the other side it creates resistance. So support and resistance. Here you can see in trend line it's a combination of support and resistance. The trend line acting as support gets broken, then becomes resistance. Now let me show you an example of a current this is the current live chart of AUD USD. Okay, as you can see, Just 3 points. You don't need more than that. This is for our timeline. This is our trend line. I use dotted lines. It broke it, and it took a while for it to retest before going on its way. Okay, so imagine if I got into the trade the instant it broke it. Let's say I was hasty. I got into the trade somewhere around here. It has broken, and then I place my entry. I'm expecting it to sweep all this liquidity, and I place my stop loss below the candle that created the breakout. Okay, if that was what I did, you see, even though I wouldn't let it get to this point before I break even, this would have been a risk-free trade because I must have broken even. But the thing is, it eventually gets stopped out before it starts moving. So that's why you don't get hasty. You wait for a retest before you get into trade. Every day is an opportunity to make money, and it's also an opportunity to lose your money. So you have to be very careful when you're doing things like this. Okay.